that are listed that have had phenomenal years, businesses growing 50% year over year. For most businesses, don't people actually want to invest in the business itself as opposed to, say, some aspect of their capital structure?
I think conventional treasury strategy is now intellectually and morally bankrupt, and it's a road to serfdom, right? And I think that what you're going to find is increasingly there's haves and have-nots, right? There's the elite that have incredible power, like the Googles and the Amazons and the Apples, and they have more money and more power and more distribution than God. And then you've got conventional businesses that have conventional cash flows, and they're being increasingly marginalized. So to ask those businesses to invest all their capital in a currency which is devaluing at 15% or 20% a year is pretty much committing economic suicide.
But the expectation,
again, it's the same thing as, why don't those investors give all their capital back to their limited partners and decapitalize under that strategy, right?
Yeah, but again, the expectation, I think, most investors is not that they're going to hold most of their money in cash per se, but that their fundamental business operations are worth reinvesting. And when I look at the numerous companies that are surging, hitting all-time highs, a proliferation of software companies and banks and industrials, they're companies that are not holding a lot of extra cash in any asset, in any treasury asset. And so the question is, why should we evaluate companies based on what they have in their treasury assets versus what they could fundamentally invest in with their operations and the things that they actually sell?
I think it's pretty clear that we have a Main Street versus Wall Street dichotomy here. And if you have a company that is asset rich, then you've got a 25% boost due to money printing of the Fed over the past 12 months. That's the M2 money supply expansion, roughly. And if you have a company which is cash rich and asset poor, your business is just getting exponentially harder, and any cash that you have is being degraded at the same 25%. The S&P is up 24.61%. Which means that if you want a proxy for cost of capital, if you invested in any kind of company that was up 5% over the past 12 months, you're not keeping up with even the index. Right? So if you're an active investor, you're going to have to find a way to get above 24%.